Fed was always supposed to be more like a event which you would analyze, but it will not have implications in terms of how it would have impacted the market. So nothing's come out of the Fed, and not that markets were expecting anything big to come out from the Fed. It was never a market moving event. What matters for the global market setup is that stability has come back in US big tech. When I say stability, of course, the levels of all-time high are not there, but that deep seek sell-off, which in a sense was really the underlying factor for Monday and Tuesday, that seems to be going on the back burner. So Nasdaq is down but not out. S&P is down, but it has not cracked. Dow is flat with a downward bias. In fact, tech stocks in US also, they've made a reasonable amount of comeback from the Monday's low. So I would mark the global setup as a setup where it appears that things are stable, things are calm, things in a sense have not really turned ugly or volatile. So I mean, Tesla down 4%, Meta up 2%, Microsoft down 5%. These are individual reaction to the numbers. There is no synchronized snowball effect which has happened because of that massive selling in big tech or some kind of an hedge fund unwinding. Crude is down, dollar is back at 108. So it is pretty much back to what we were, let's say, last Friday in terms of the global setup. The bias may be lower, but the bias certainly is not looking, but the terrain is certainly not looking very ugly.
And quite a bit of commentary as well coming in on what the future course of action from the Fed is going to be. David Solomon, the CEO at Goldman Sachs, stating that unless we get some policy action that really changes the trajectory of inflation, I think we'll be in a narrow band with the policy rates. As you look out through 2025, he says, I think the range of outcomes is a pretty narrow positive, or rather position on policy. Some more details coming in from Jeffrey Gundlach saying that maximum 2 cuts this year. So he's definitely sticking his neck out on, the prediction of the rate cut trajectory, saying, and I mean maximum, I'm not predicting 2 cuts, he says. He says, I think that's the most you can possibly think about. It's going to be a very slow process to get a hurdle to cut rates again. And I don't think you're going to see a cut at the next Fed meeting either. He's obviously focused on the stability and the unemployment rate right now, referring to what Jerome Powell's thinking or the Fed's thinking is of not feeling a need to cut rates. And I think that rates have not peaked on the long end. And I think rates will have another move up on the long end. That's the word coming in from Jeffrey Gundlach. But like we said, it's pretty tempered and simmered across the global street. And for our markets, we managed to definitely recoup some of those losses from last week. We've managed to advance for a second consecutive session, but just a very, very slow grinding move up. We've made it back to 23,100, but I don't know if, Nikunj, the temptation on the street to book out at every given uptick is still high.
See, I'll just talk about what's happened this week, and we must throw in one more ingredient, which is that today's FNO expiry. Haven't spoken about it. So obviously there would be a little bit of adjustment in terms of short, long, all that will happen. Now, was there a particular, so for me, if I look at the Nifty, you had a Nifty range which in a sense has moved as per the script. Last 10 days, Nifty has moved in a narrow band, and the bias in last 2 days has been positive. B, there is definitely an element of short covering which is visible looking at the way how FI and FNO moved on Tuesday and the kind of activity we've seen by FIs in the FNO market in terms of fresh long. So are we at a turn in terms of next couple of days, which is, let's say, today till Saturday, today till next week, in terms of a pre-budget rally, or there is just a bout of short covering ahead of FNO expiry, little bit of long bias? That's one. I think there is merit in thinking positive, at least in the run-up to the budget, if you're really thinking short-term. Second, the banking space is in a leadership position, which I think is evident in the way how private banks have delivered and the kind of money which is moving. That's second part, that leadership is approaching in banks. And the tricky part, Aisha, is that how do you approach small and mid-cap stocks now? And now that is the tricky part. And there is no one shoe fits all kind of a strategy in the small and the mid-cap space. I expect the following in the mid and the small cap space. If you don't know what you own, please get out, raise cash. If you know what you own, then be prepared for a 15-20% volatility, maybe another 15% downside. If you cannot bear that, still, I think it's time to raise cash and move to large cap. I think it's too early to make a case that you should start buying, and it is too late to say you should stop selling. We are in that phase where the damage has been done, but the markets have not become attractive. Having said that, not everything in the small cap space will come back whenever markets will come back. The leadership pockets, according to me, one is banking. The second leadership pocket in my mind really could be pharma. And the third comeback pocket in my mind really could be classic consumption in form of FMCG and maybe some infra stocks. Barring that, I don't see too many pockets. You've got small and mid cap stocks, you've got to ask yourself, why have you bought it? If you don't know the why, then you need to be out. If you know why have you bought it, then be prepared for a 15% volatility. If you can't take it, then get out. And if you know, if you can digest a 15-20% volatility in the stock which you know and which you like, I think then don't sell. Then just stay put. A year from now, things will be better.
Yeah, but I think the consensus on the street, like you're saying, is pretty evident out there that, you know, stay put with the large private banks, clean large financials, and the tilt in your portfolio right now, if you want to see good returns till the next 1 year at least, needs to be large cap.
You know, you're in that phase of the market where capital protection is more important than capital appreciation, where you will lose less. You will lose less in large cap because they are cheap. You will lose less in banks because they have not participated. So the margin of safety is not in PSUs. So you have to ask yourself is that what could happen? When you come out of this kind of a shakeout, typically the market will take time before they stabilizes. And there are a lot of folks on the street who would say, we own the stock, it went from 100 to 500, it's come down to 350, now on the bounce we'll sell back. Market has to digest that. That is not going to happen in banks. That's my limited point. Numbers are not bad, they're cheap, and there is limited supply which could come on every uptick. And the leadership is change, and I think it is changing.